is actually securitized. So right from understanding the process and even going ahead with some of the frictions underlying this process, we would look at the key characteristics of the subprime mortgage market and even the credit rating process associated with this, and some kind of predatory lending and borrowing activities. So just to get a brief hold of the same, the first thing I would like to look at is the securitization process involved with respect to the subprime mortgages. Securitization process. Now, all it initiates is with the borrower. Let's say a home loan borrower is there, right? Someone who wants to purchase a house, but he requires funds to purchase it. So he approaches for a mortgage, probably a bank. He approaches a bank for a mortgage. Now, the bank will do its proper due diligence of the party as well as the property and various other aspects. The bank will be performing a proper due diligence, and it may come forward to sanction the loan. And generally in these cases, the residential property is generally taken as a collateral for all these transactions. The property is taken as a collateral here. Now, when I look at the profile of the borrower, generally I categorize them into three major aspects. One being a prime borrowers category, one is a subprime, and one is the RTA category, that is the typical name associated with it. So when I look at the prime borrowers, they have very good credit history, whereas the RTA borrowers, probably they also have a good credit history, but probably they might have applied for very high loan, very heavy loan, or probably for a very longer time period. So probably the kind of application they have put forward requires some stringent evaluation of the party. So that is where these parties get categorized as RTA category. And the third one is the subprime, which is where they don't have a good credit history itself. They don't have a good credit history. Now, the borrower could fall into any of these categories. And typically, in any securitization process, as we understand, the bank, all these loans will become the assets to the bank. Right? All these loans are assets to the bank. Now, what the bank or any lending institution it can do is a significant portion of them are sold because they are assets. They are sold to third parties, typically called as special purpose vehicles, and they get back the cash to run their day-to-day operations. So these properties which are